Why do wealthy people sometimes borrow millions, while someone living paycheck to paycheck feels terrified of owing even $1? The answer is not that rich people love debt. They understand that different debts can create completely different financial outcomes. One kind of debt buys something that loses value. Another can purchase an asset, expand income, or preserve valuable cash. The difference is not confidence, intelligence, or social status. It is the purpose, structure, cost, and repayment source behind the loan. I'm Professor Wealth, and today we'll separate useful leverage from the debt traps that quietly destroy financial freedom. We'll follow Daniel, a careful small business owner deciding whether borrowing money can accelerate his progress or place everything at risk. Daniel has a $120,000 in savings, a profitable operation, and an opportunity to open a second location in another growing neighborhood. The expansion costs $200,000. He could spend nearly all his cash, borrow part of it, or walk away completely. A fearful borrower sees only monthly payments. A strategic borrower studies cash flow, downside risk, flexibility, and the exit plan. By the end, you'll know exactly when debt can be a tool and when the smartest move is simply saying no. First, debt is an agreement. You receive money today and promise to repay principal, interest, fees, and sometimes collateral. Debt itself is neither rich nor poor, good nor evil. Its effect depends on what the borrowed money produces afterward. A credit card balance from vacations creates no future income, while a loan for profitable equipment may increase production every month. Both are called debt, but one consumes tomorrow's paycheck, while the other can help create a larger paycheck tomorrow. That is why strategic borrowers begin with one question: what cash flow will this debt create, protect, or unlock? Many struggling households experience debt differently because borrowing often covers emergencies, food, rent, transportation, medical bills, or essential family needs. Those loans do not arrive with matching income. They appear because income was already insufficient when the expense arrived. High interest then removes even more cash from future months, making every new emergency harder to absorb without additional borrowing. So fearing debt can be completely rational when past borrowing created stress, shame, collection calls, or years of minimum payments. The lesson is not to become fearless. It is to become precise about which risks deserve caution and which deserve analysis. Destructive debt is expensive, borrowing used for consumption, status, or purchases that quickly lose value and create no income. Neutral debt solves a real need, such as reliable transportation, but it does not directly create additional income. Productive debt finances an asset or activity expected to generate cash flow, greater efficiency, or durable long-term financial value. These categories are only starting points because purpose, price, timing, execution, and borrower discipline determine the real outcome. A car loan can fund luxury, enable commuting, or purchase a delivery vehicle that actively earns business revenue. A mortgage may build wealth only when the price, payment, maintenance, location, and holding period actually make financial sense. A business loan may expand profit or simply finance a weak business model that was already losing customers. The label never guarantees success. Numbers, behavior, economic timing, and a margin of safety determine whether leverage helps or harms. Even a sensible investment can fail when debt payments continue through a downturn, so survival capacity matters more than optimism. Now return to Daniel. His current store earns about $18,000 monthly after operating expenses, but before taxes and his salary. The second location is projected to add $14,000 in monthly revenue and about $5,000 in monthly operating profit. Daniel could pay the full $200,000 in cash, but only $20,000 would remain for emergencies, inventory, and construction surprises. Avoiding interest sounds safe, yet the business could become profitable on paper while dangerously short on usable cash. Daniel's bank offers a $120,000 5-year fixed-rate business loan, requiring roughly $20,400 in predictable monthly payments throughout the term. He would invest $80,000 himself and keep $40,000 as additional operating reserves after the second location officially opens. On paper, the new store earns $5,000 monthly, pays $2,400 to the bank, and leaves about $2,600 before taxes. That positive spread is the attraction of productive leverage. Expected asset cash flow exceeds the total financing cost, but expected profit is never guaranteed. So Daniel carefully tests weaker sales, higher expenses, and delayed opening dates. If profit falls from $5,000 to $3,000, the loan still gets paid, but Daniel keeps only $600 monthly. If profit falls below $2,400, the new location cannot service its debt, and the original store must cover it. Wealthy investors focus less on the best case return and more on how long they can survive the bad case. Daniel calculates 6 months of loan payments, payroll, rent, utilities, and inventory before choosing his required cash reserve. He also asks about a personal guarantee, because business debt can become personal risk when the contract crosses that line. A personal guarantee may allow the lender to pursue Daniel's home, savings, or other assets if the business cannot repay. That clause does not automatically reject the loan, but it changes the true risk and demands a larger safety margin. Daniel negotiates a fixed rate, no prepayment penalty, clear collateral limits, and several months before full principal payments. These details rarely appear in motivational videos, yet loan structure can matter as much as the advertised interest rate. Strategic borrowers do not only ask whether they qualify, they ask whether the payment remains survivable when growth arrives slowly. Now imagine an investor purchasing a $300,000 rental duplex with $75,000 down and financing the remaining purchase amount. The $225,000 mortgage allows control of the entire property without investing the full purchase price entirely upfront in cash. If the property collects $2,700 monthly, rent must cover vacancy, repairs, taxes, insurance, management, and the mortgage payment. Gross rent is not profit. Ignoring operating costs is how attractive-looking leverage quietly becomes negative monthly cash flow. Suppose total expenses reach $350 each month. The property produces only $350 monthly, not the impressive headline $2,700. That return may improve through higher rents, lower debt, or appreciation, but none of those outcomes is guaranteed. Leverage magnifies gains because a smaller personal investment benefits from changes in the property's much larger full market value. A 10% increase adds $30,000, equal to 40% of the original $75,000 down payment before transaction costs. But leverage also magnifies losses. A 10% decline can erase $30,000 of equity while the mortgage barely changes. If the unit stays vacant for 3 months, the bank still expects every scheduled mortgage payment on time. That is why leverage rewards resilience. Borrowers with reserves can survive disruptions that force fragile owners to sell. Business owners use debt to purchase inventory, machinery, software, vehicles, or productive capacity that can expand daily operations. A bakery might borrow $40,000 for an industrial oven that doubles production and reduces labor during its busiest season. If the oven creates $6,000 in added monthly gross profit and costs $900 monthly, the economics may be attractive. But the owner must confirm demand exists. Faster production is worthless when customers are not waiting to buy more. Productive debt should remove a proven bottleneck, not finance vague hope that a profitable market might eventually appear. Large companies also borrow while holding cash because spending every dollar can reduce flexibility for payroll, research, acquisitions, or emergencies. They compare financing cost with expected return, timing, risk, and every realistic alternative use of their available cash. Debt never creates free money. Interest is real, refinancing can fail, and tax rules cannot rescue a bad investment. Another advantage is matching the loan term carefully to the realistic useful life of the finance business asset. A 30-year building may support long financing, while a 10-year loan for short-lived technology creates a dangerous mismatch. Smart borrowers avoid paying for an asset long after it stops producing value because old debt blocks new opportunities. They compare fixed and variable rates. Fixed payments offer certainty, while variable payments may rise when conditions change. A low introductory rate can look affordable until the reset date increases payments and destroys the cash flow cushion. Refinancing is a possibility, not a plan. A safe deal should not depend on a future lender offering better terms. Collateral matters because secured lenders may seize the pledged asset after default, regardless of the borrower's emotional attachment. Experienced investors often isolate projects legally, so one failed investment does not automatically damage every other valuable asset. That protection is imperfect, especially with personal guarantees, but thoughtful structure can prevent one mistake from spreading everywhere. Low-income borrowers often receive the worst debt, facing higher rates, smaller limits, and far fewer affordable lending alternatives. Someone with unstable income may need credit precisely when lenders consider them risky, producing expensive terms at the worst moment. Payday loans and revolving balances can charge enormous costs without buying any asset that generates income or appreciates. The cycle feels predatory because payments arrive before the underlying income shortage has actually been permanently solved for the borrower. An established investor may borrow cheaply against strong collateral, while access, pricing, stability, and professional advice explain much of the advantage. Copying a wealthy person's visible loan without copying their reserves, income, expertise, and lender relationships can be extremely dangerous. Copy the analysis, not the loan amount. The same debt can be manageable for one person and catastrophic for another. Consumer debt becomes harmful when dinners, clothes, vacations, and upgrades disappear long before the remaining balance is finally repaid. Even a 0% promotion becomes risky when a large balance remains after the promotional period suddenly and unexpectedly ends. Debt creates an affordability illusion by focusing attention on monthly payments instead of total cost and opportunity cost. A $700 payment may feel manageable, but it can eliminate retirement savings, emergency reserves, insurance, or career flexibility. The first major risk is income interruption. Loans feel easy during stable months and unforgiving when work or sales decline. The second risk is changing interest rates, especially when variable payments reset faster than household income can adjust. The third risk is asset decline. Property, businesses, vehicles, and investments can lose value while the loan remains unchanged. The fourth is concentration. One highly leveraged project can threaten an entire financial life when too much depends on it. The fifth is behavior. Easy credit can encourage overconfidence, repeated expansion, and the belief that earlier success guarantees safety. The sixth is liquidity. A borrower can own valuable assets and still default because bills require cash on specific dates. Strong investors build protection layers through cash reserves, insurance, diversified income, conservative projections, and carefully written exit plans. Those protections do not remove uncertainty. They reduce financial damage when the original forecast eventually proves seriously wrong. Question 1. What exactly will the borrowed money purchase, and how long will that financial benefit realistically last? Question 2. What reliable cash flow will repay the debt without depending on overtime, perfect occupancy, or constant growth? Question 3. What is the total cost, including interest, fees, insurance, maintenance, taxes, and all required professional services? Question 4. What happens if revenue falls 30%, expenses rise 20%, or the project is delayed 6 months? Question 5. What collateral, guarantees, business property, or personal assets become exposed if repayment fails during a difficult period? Question 6. What is the exit plan? Sell, refinance conservatively, repay early, or close without destroying everything else? If those answers remain vague, debt is not a strategy. It is optimism wearing a professional-looking financial spreadsheet. Daniel discovers the project works only if construction remains below a strict maximum budget with no emotional upgrades. He negotiates the lease, reduces renovation scope, keeps 9 months of reserves, and delays hiring until sales confirm demand. He chooses a smaller $100,000 loan instead of accepting the maximum amount the bank originally offered him for expansion. Borrowing less reduces projected profit slightly, but gives Daniel more control and lowers his personal guarantee exposure significantly over time. After opening, Daniel closely tracks weekly sales, labor costs, inventory turnover, reserves, and the debt service coverage ratio every week. When results exceed expectations, he does not immediately open a third location. He repays debt and strengthens systems first. When 1 month disappoints, reserves cover the payment, while Daniel calmly adjusts marketing strategy and daily operating costs. The debt works because the business produces cash, the terms are controlled, and failure would be painful but survivable. That is the principle. Wealthy borrowers acquire productive capacity, while financially fragile borrowers often use debt to survive consumption. Wealth is not created by borrowing alone. Disciplined decisions must make the borrowed capital produce more than it costs. Fear every debt blindly and opportunities disappear. Trust every loan confidently, and one mistake can erase years of progress. The goal is knowledge, cash flow, and protection. enough to use leverage without allowing leverage to control you. First, eliminate high-interest consumer balances, build emergency reserves, and calculate total borrowing cost before considering any productive debt. Then begin small. Demand conservative numbers. Read every contract carefully, and never risk money required for basic security. Debt should serve your plan, not become the plan. The asset must keep working after the motivational story ends. Rich people do not win because they owe more. They win when assets, cash flow, and safeguards remain stronger than obligations. Use debt only when the repayment source is clear, financing cost is manageable, and the downside remains financially survivable. Most importantly, keep the power to say no whenever the terms, assumptions, or personal risk no longer make sense. Thank you for watching. If this video helped you better understand debt, cash flow, and financial risk, please like the video and subscribe to Tutor Financial. Turn on notifications so you do not miss future videos about money, investing, and building long-term financial security.